If you download a modern telehealth app today, the experience feels entirely frictionless. You tap a few buttons, and an AI chatbot instantly evaluates your symptoms. Companies like Hims and Hers are now syncing that AI directly to SmartScales, pulling in real-time data to track patients on GLP-1 weight loss medications and instantly generating personalized care plans. For a software company, this is an economic dream. Once the algorithm is trained, rolling it out to 1 million new users requires almost zero physical overhead. But the moment you start generating millions of highly personalized medical responses, that digital illusion crashes into a very physical reality. The cloud isn't floating in the sky. All of that effortless consumer convenience is anchored to a gritty, heavy world that most users will never see. That heavy world belongs to the landlords of compute space. This is a massive new real estate sector building highly specialized data centers designed specifically to house liquid-cooled AI servers. Getting those facilities off the ground requires an astonishing amount of capital. Pure-play infrastructure companies like CoreWeave are taking on nearly $33 billion in net debt just to pour the concrete and set up their systems. And money isn't even the biggest hurdle. You still need the electricity to run them. Securing a power purchase agreement, a contract to legally pull massive amounts of raw power from a local grid, can take 7 to 10 years to get approved. That extreme delay is exactly why legacy clean energy Bitcoin miners like IrisEnergy are suddenly pivoting to AI. They already secured those coveted grid agreements a full decade ago. It exposes a harsh truth about the artificial intelligence race. Having the smartest software is useless if you can't secure the physical space and the raw electricity to plug it in. Because of this bottleneck, a lot of smaller AI infrastructure companies are finding themselves caught in a financial trap. They boast multi-billion-dollar backlogs of eager client demand, yet they are fighting to survive. This is known as the cost of capital illusion. Firms like Applied Digital and Hive hold massive order books, but they don't have the cash on hand to actually build the servers to fulfill those orders. To service those contracts, they have to put up billions up front before seeing a dime of revenue. That means taking on toxic levels of high-interest debt just to start construction. The alternative is issuing massive amounts of new stock to raise that upfront cash, heavily diluting the value of their existing shareholders down to near zero. They are trying to compete with hyperscalers, the massive tech giants like Meta and Google, who have the liquid capital to simply buy premium hardware outright. An endless backlog of digital demand looks great on an earnings report, but it means absolutely nothing if the physical cost to fulfill it bankrupts the company in the process. For the last 20 years, Silicon Valley has sold a highly profitable story. They convinced the world that technology was a weightless, virtual commodity. But to guarantee they have the compute power they need, those exact same tech platforms are abandoning the myth of the cloud, spending billions to acquire sprawling real estate and build their own physical data campuses. The massive energy and space requirements of artificial intelligence are dragging the tech sector violently back into the realm of capital-intensive, heavy industry. Dominating the next decade of computing requires deep pockets, raw megawatts, and the industrial muscle to pour concrete at scale. The expansion of AI has become a high-stakes competition of massive debt obligations and the sheer consumption of steel and energy.